Enough of the hard sell about Rodgers Reidy. We're here for 60 minutes to talk about something exciting and entertaining. 60 minutes of hearing about Collingwood's premiership. Is that what we're on, Glenn?
Yes, that sounds
certainly what I'm going to talk about.
Is that what you're going to talk about as well? Brody, fantastic. No, I tease. We'll lose people very quickly if that was the case. No. Our webinar today, it's an exciting webinar. We have three of senior National Australia Bank members who are going to talk on the current state in the Australian economy and factors influencing financial distress. Firstly, the webinar will look at the bank's economic forecast with someone who we're very blessed to have, and that's Brody Viney, who is the Chief Economist for National Australia Bank. Following that, we have a panel discussion, which is going to be led by our Rodgers Reidy's National Head of Banking and Finance, which is Charles Saliba. I'll go into introductions to these people shortly. Luke Jones, who's Head of Strategic Business Services in Victoria, Tasmania, South Australia at the NAB, and Glenn Collins, who's the Director of Growth Origination at NAB. And they will speak on factors influencing financial distress in the Australian economy. Now on to the first speaker. As I said, we are blessed to have Brody Viney from the National Australia Bank. He's a senior economist at NAB's Australian economics team, leading work in macroeconomic forecasting and analysis at NAB's regular business surveys. He's previously worked at the World Bank, Washington, and at the Commonwealth Treasury. He holds a BA in economics from Melbourne University and an MBA in economics and a public policy from Princeton University. Very impressive. And a Collingwood supporter?
Correct.
Wow. Even more impressive. Please welcome Brody today. Thank you.
Thank you, Brent. Thanks also for the promotion to Chief Economist. Alan Oster, but maybe in another decade or two, I can aspire to those heights. Thanks very much for having me. I just take the moment to acknowledge the traditional owners of the land we're meeting on as well. We want to people and pay respects to elders past, present, and emerging. I'm going to talk a little bit about economic conditions and the outlook today. A rough outline of what I'll go through. So just about sort of current business conditions and some of the pressures that are on households at the moment, which we know are very significant, and sort of talk through some of the mechanisms that are impacting demand there. And then sort of the inflation outlook and some of the implications for profits and solvency, which are relevant to this audience. And then sort of our outlook for monetary policy and our key forecasts for Australia, and a bit of time for questions. I was saying before, I'm very happy to take a question on the fly if anyone's got a burning question about something that's up on one of the slides, but I think we'll have a bit of discussion at the end as well, Charles. So sort of the big picture is that, we've been in this big rebound period coming out of COVID, and I guess one of the key messages we would have at the moment is that rebound is really coming to an end, but the economy is still reasonably robust. So this is from our business survey, which has actually just come out this morning for September. And you can see their business conditions for the red line have been very elevated through this rebound period. So business is doing really well. That started to track down. So a bit of normalization going on as we come out of that period, but still at a reasonably robust level. So this might be slightly outdated here from this morning, but now at about 11 index points, but still very, very much a robust level of business conditions. So well above historical average. And so, we're seeing that really across the states. We've got Victoria highlighted here. This is relative to the historical average across the states, but business conditions really tracking reasonably well right across the board. And we know also that labour markets are still very, very tight. So we've been through this period of major population growth coming out of COVID after that period where borders were closed and population stalled. And that's left us with this very, very tight labour market still. So unemployment is still around 3.6, 3.7% now. Look at the month-on-month or monthly number. So that's a historically low level. If we took this chart back to sort of the 70s and 60s, you wouldn't see a number that low. We know then there's sort of these major impacts going on for households. So interest rates are very substantially weighing on household income, disposable income. So this is sort of the change in disposable incomes in aggregate for households since since the COVID period. So you can see the black line is sort of that net or aggregate impact on disposable incomes. And so disposable income still been growing through this period. That's all mostly being driven by this red bar, which are the impact of wages. So that's stronger wage growth for households or individuals, but also total employment growth. So a bigger population, but also jobs for those people, supporting people's incomes. Along with that goes people paying more income tax. That's the purple section, which is the major sort of thing that sucks away disposable income. Then these dark blue bars here is sort of the rising interest payments that households are facing through the past sort of year as interest rates have risen. Importantly, though, this is in aggregate. So these impacts are unevenly distributed. So some households are actually benefiting from higher interest rates because they've got maybe interest-earning assets. Other households maybe not exposed to interest rates at all if they're renters, but they may be facing other pressures. And then that interest impact is particularly concentrated where there's people facing that mortgage adjustment. The key thing, though, is that in real terms, incomes or disposable incomes have been going backwards. So this black line here is the same line from the other chart. So that's nominal disposable income, which has still been rising, even though it's been dampened by those interest rate impacts. When we adjust that for inflation, real disposable income has been tracking down really since the sort of start of 2022 or even late 2021. And so what we have there is that, I think this makes really clear that really inflation is the bigger force driving that adjustment for households. That it's really that adjustment in what their buying power of their wages are that's really impacting households' ability to buy and consume and live in the way that they were before. And very importantly, these effects being felt unevenly across households. So this is from our consumer stress index, or this is our consumer stress index from NAB's consumer sentiment survey. So we ask consumers how they're feeling. We ask them about the stress they're experiencing, rated from sort of 0 to 100, 100 being sort of extreme stress. And we ask them about stress related to different things, cost of living, their job security, and other aspects, and we sort of bring that all together in an aggregate index. And so that aggregate index is at 56.9. You can see that first bar, which is actually a little bit below average, but it's been rising. But when we disaggregate that across different groups, different households, you can see there's a big range of stress across the community. So just to touch on before, the stress is particularly high among lower income households, but also among renters, where people are exposed to some of those rent increases that have been going on. I'll talk a bit more about the housing market a bit later. Also, unemployed segments of the community facing much higher stress than others. So, that sort of makes sense that those more vulnerable groups on lower incomes, where those cost of living increases are the most impactful, having the most experiencing the most stress. Other groups, as I said before, may be experiencing things a bit differently. So interestingly, the stress is lowest among the 65 plus age group, where perhaps those mortgage and rent increases are less of a factor, at least for some and again, where people might be more likely to have interest-earning assets and maybe actually seeing some benefits of higher interest returns on savings. So combined with that impact being disaggregated or different across different households, we also have sort of this aggregate growth coming from population growth. So I said before, we've been through this, we're in the midst of a very rapid rebound in population from the closed border period. Net migration has been running around 450,000 in the year to March. So that's well above sort of a more historic number, which would be more like 200 to 250,000. And our more timely data suggests that population growth is running about 2.8%. So that's way above, historic average, which would be more like 1.6. So what's key to understand here is this is sort of driving aggregate growth in demand. So even if individual households might be really feeling the pinch and cutting back, in aggregate, there's more people buying, there's more people consuming, there's also more people needing a roof over their head, which we're seeing in the housing market as well. So this is contributing to aggregate demand, and it's part of what's keeping those business conditions, which I pointed out at the start, at that really robust level. So for businesses, what they see is the total amount of demand in the economy, not what individuals are facing. So they're sort of still seeing that robust level of growth coming through, which is being supported by population. So then sort of how are consumers adjusting to that? And this sort of the rubber starts to hit the road. So we know consumers are cutting back in discretionary areas. So this is sort of real consumption, so adjusted for inflation impacts. And you can see that, essential consumption has still been growing pretty steadily through the last year or two. But what's changed has been discretionary consumption. So discretionary consumption took a huge hit during COVID. Through those lockdown impacts, people couldn't go out, eat, go on holidays and do all those things that you might normally like to do. That's rebounded very dramatically to almost sort of above normal levels through this rebound period. So that's part of what's also been driving that rebound. People sort of doing more of those discretionary things, making up for lost time, things they couldn't do during COVID. Sort of since late last year, as those inflation impacts have really started to bite, as that impact I sort of showed on disposable income in real terms started to decline, we've seen that discretionary consumption start to decline. So this is not even adjusted for population. So this is overall discretionary consumption starting to come back, even though the population is still growing. So that means sort of in a population adjusted sense, discretionary consumption has been really falling per capita. So people really starting to cut back where they can. The other part of the adjustment for households is that savings rates are coming down. So as households are having to devote a larger share of their income to those living costs, those essential things, but also housing costs as well. So it might be mortgage payments or rent. That's drawn, or people have adjusted down, adjusted where they spend their income away from some of those discretionary things, but also from savings. So we saw savings rates went very, very high during the COVID period. That was partly because people couldn't do that discretionary spending, but also incomes were protected by government through that period, we know well. We're now seeing the sort of unwind of that, and even beyond an unwind of that high savings rate, we're now in a sort of lower than normal savings rate. So savings ratio during sort of the pre-COVID period, something like 6.5%. It's now down to 3%. Importantly, that's still positive, but this is on aggregate again, or on average across the economy. So this is unevenly distributed as well. So some household savings rates obviously be much lower than this, potentially even negative. Other households will still be saving at a reasonable rate. But it is important that on average across the economy, that's still at a positive rate. And where this adjusts next is one of the big uncertainties for us as we think about what's going to happen to the economy over the next period. We know that households built up sort of accumulated buffers of savings, so the stock of savings grew during this period. Some of that went into offset accounts, maybe into other investments, but also some of it might be in more liquid forms of saving as well. So even now, with savings sort of below their historic rate, at the run rate, they're still in that positive territory. So households aren't even necessarily in aggregate drawing down on their equity to sort of maintain their lifestyle or their living costs at the moment. So it's totally possible, as you can see, that this could go to zero or even negative over the next little while if households sort of are willing to save less and maintain their consumption more during this period. So more room for adjustment to go there. But that has been a big adjustment that households have made to try and get through this period. So then sort of on to sort of the inflation outlook. So we know inflation is slowing. People have seen that headline across the board, from a peak around 7% late last year to now around 5%. But the big question is sort of how much further will it go and how quickly will it come down? And there's sort of two parts to this puzzle. There's the improvement that we've seen around goods inflation, which is the red line here. So that's where all of that inflation was driven by, or a lot of that inflation was driven by supply chain shocks that businesses were experiencing during COVID. We've really seen a lot of that start to unwind. So all the measures we track around supply chains are now pretty much back to where they were before COVID. That takes time to flow through to businesses through their, purchasing and their inventories and all of those things. But it's starting to flow through to prices for goods. And, you can see that's come down. So that's around that sort of 5% mark now. Our outlook for this is that we expect that to continue. So there should be continued improvement in inflation coming from that goods side as those sort of inventories pass through that lower cost over time for businesses. The other piece of the puzzle, though, is services inflation. So there's a much larger part of the economy, and it's much more driven by domestic factors around labour costs, around energy costs, around rents that businesses are paying as well. And so this is where, that aggregate demand outlook and around what the RBA is doing is really critical to try and keep a lid on or keep control over that services inflation side. And you can see the service inflation has actually been rising. It's continued rising through the past year, even as that goods inflation come down. So there's sort of been some offsetting factors there. And now actually service inflation is running faster than goods inflation. So it's kind of the key part contributing here. And we expect that to continue to be the case. So as that goods inflation drops, we're still expecting service inflation to maintain sort of that higher level for a while. We do eventually think that we should start to come down. So But again, that's the big uncertainty and the big question that the RBA is grappling with. So for businesses, what does this mean? Well, cost growth has been improving, so but it remains very elevated. So this is from our survey today. Labour cost growth has been quite high. It's been tracking down, but you can see there's been these major spikes around July, which has been around those minimum wage impacts and wage adjustments that happen in July more broadly across the economy. They've been driving, quite significant increases in labour costs. And you can see here, like way higher than we've ever recorded in our survey before. The good news is that since that July survey that we had this year, which showed that big increase from the minimum wage impact, labour costs have started to come down again. So in today's survey, back down to 2% at a quarterly rate. That's still very elevated, as you can see. More like 1% historically would be a more normal level. But it's probably a good sign that that shock that we saw around July was reasonably contained or sort of one-off. The purchase cost side, which is more around those goods impacts, but also energy costs, which includes oil costs. We've seen a similar story with that improvement in purchase costs over time. Again, we've seen that volatility recently, particularly around oil price changes around August and September, but also some of those exchange rate impacts potentially have an impact on the purchase costs for goods and other inputs for businesses. The good news is, again, we saw that today come down a little bit, back down to 1.8%. And so really the outlook here is, we're hoping or expecting that this trend will continue a bit of moderation in those costs, but there's a long way to go to get back to something like normal. So this is going to continue to put pressure on businesses over the period ahead as they've got to grapple with those costs. So far, businesses have mostly been able to pass through those costs to their prices. Because we've been in that period of really strong demand, because the population's been growing, because people have been doing that catch-up consumption, businesses have been able to pass through those costs in the form of prices and maintain their margins. This has been a really important story, and people have seen the debate around this in the media as well, and happy to dive into it in a bit more detail. But this is sort of really where we square the circle on the inflation outlook and the demand outlook. So what we have in our business survey, when we look at profitability, so this is our profitability index, you can see it's been really elevated through this period. That just means lots of firms have been able to stay profitable despite those elevated costs they've been facing. So again, that's that strength in demand, allowing firms to stay profitable. We can see that's been tracking down, so starting to normalise towards a more long-run average level, which is the red line here, around 5 in our survey. We should expect this to continue. So as that demand starts to ease, as people are cutting back and continue to cut back on those discretionary items, to the extent that there's still that cost pressure coming through from labour costs and from energy and all those other things, what that's going to mean is that businesses have less scope to pass through those costs to their consumers, and so they have to wear more of that in their margin. And so that's really what's been going on already. And I think sort of the message from today is that sort of the mechanism of adjustment that brings inflation down that the RBA is sort of actually targeting. It's not talked about as much, but that's sort of where the rubber hits the road. If businesses can't pass through all those costs, they eventually have to raise their prices by less, and that means less inflation in the end. But what that looks like for a business is that squeeze on margins. So I think the sort of warning from today is that that's likely to continue to be the case, or to be a pressure for businesses for some time. Keeping an eye on the time. So just if we look at that profit adjustment across different industries in our survey, one of the big stories in the past year has been construction. I'll talk more about that in a second. You can see in our survey that the construction industry had sort of negative profitability or a negative index in our survey through much of last year, even from 2021. And we know that was because in that sector, those cost pressures were particularly acute around their ability to find materials and also labour. But a lot of those businesses also were on fixed price contracts where they couldn't renegotiate or were limited in their ability to pass through those prices. So they've sort of been historically, over this previous period, the outlier around that profit story where they weren't able to maintain those margins and weren't able to stay profitable in the same way. We've seen that flow through to insolvencies and other things, which we'll talk about in a second. Probably the good news story for the construction industry is that as some of those cost pressures have eased, And also, as there's been more scope to reset some of those prices as time's gone on, that index has actually improved in our survey. So now they're back at around +9. So that's actually quite a reasonable, healthy level for the construction industry from our survey. The story now is around sort of that more generalized slowing in demand, particularly in discretionary sectors, and that squeeze on profits. And so you're seeing that flow through. So you're seeing, retail and wholesale, particularly retail, seeing that profit index starting to normalize here or starting to come down. The same story with this, the yellow line at the bottom, which is recreation and personal services. So that's particularly things like hospitality, arts and recreation, other things, that are particularly in that discretionary bucket. So you can see there that, that sector was particularly impacted by those COVID lockdown periods, has been through a period where profitability has been elevated over the past year, but is now sort of normalizing back down to a more normal level and potentially further to fall there. So then just on to sort of some insolvencies data. I pulled this for today. So, hopefully you guys will know more about what's going on with insolvencies than I will, but from the big picture perspective. So, we saw insolvency appointments and companies entering administration really go to record lows during COVID. So we know there were lots of different things going on that, protected businesses during that period. And so, this has actually been a period where a lot of businesses have survived, potentially where they otherwise wouldn't have. And you can see now sort of all our data on insolvency suggests that those rates of insolvency have much normalized, but they haven't necessarily spiked to sort of much higher levels than that. So, this is sort of smooth data. It's pretty volatile, but, that's back around sort of where you can see where it was pre-COVID across those different measures. One of the things that's potentially contributing to that has been the resumption of ATO enforcement around debts. We know there's been a lot of stories around that. But it's also that broader story around margins being squeezed a little bit more, and particularly around the construction sector. I'll sort of show some data on that in a second. I guess what I'd say is sort of more broadly, you can see how high these rates of insolvency got sort of in past periods of distress, particularly around sort of 2008, 2010. Potentially if we go through a period where that inflation, that demand is coming down and inflation is gotten under control, but those cost pressures remain for businesses, that maybe means more businesses getting into that period of difficulty. So then I've just pulled this from the RBA's Financial Stability Review, which is out last week, where they dig into this data in a little bit more detail. So you can see actually that rise in insolvencies has been particularly concentrated in the construction sector, which the RBA says has contributed about 1/3 of the rise in insolvencies since the COVID period. So that aligns with that story I was talking about before around that sector being particularly under pressure over the past year. I think, you can already see in this data, there's a bit of a stabilisation in the rate of insolvency in construction, and that sort of aligns with that sector starting to get back on its feet, maybe a little bit as those cost pressures come down. The other one here is, you can see arts and hospitality has started to rise as well. So, again, that demand easing there in that sector, potentially starting to have some impact on businesses. If we look at sort of non-performing loans by sector, you can see it's a very similar story with construction, really the standout there. Again, and the FSR notes that sort of these loans only account for a small amount of banks' business lending. So sort of financial stability risks from this are low, but it's maybe a story more around where's the pressure going to businesses. So then just to sort of turn more to the forecast for the period ahead from us. So we still have one more rate rise penciled in for after the Q3 CPI data. So that will be the November meeting. It's probably line ball, but that's our current forecast. So you can see rates at 4.1%. They're back around sort of 2012 levels for the cash rate. It's still what we would think of as only probably marginally restrictive. So our assessment is neutral for the interest rate for the RBA, somewhere between 2.5% and 3.5%. So at 4, you're clearly above that neutral range, but only a little bit above. So there's still a bit of support there for the economy, or at least not a lot of it's certainly not hitting with the sledgehammer. And by contrast, we know other countries, the US and others, are more like 5.5%, so a much higher rate. We do think there's probably those pressures coming around rents, around that wage pressure that came through in July, and some other things that will probably push the RBA on their next meeting after they get the Q3 CPI data. So we get that later this month, and we expect it to show sort of a 1.1% inflation for the quarter. And that would be sort of a re-acceleration, a small re-acceleration from Q2. And, you know, the risks for the RBA here are really around, can they be confident they've done enough to make sure inflation is coming down, to make sure they've really locked in that sort of demand slowing, that squeeze on margins process that I've been talking about. We think the risks there are still to the upside for them, and that should push them to take out a little bit more insurance, as they've described it, around making sure inflation does come down back to their target. So that's the logic behind one more rate rise in November, but there's no doubt, you know, they've done a lot, and it's quite possible they'll call time at 4.1%. Either way, I think the other message is, you know, we don't see significant cuts coming to rates anytime soon. We have cuts to the interest rates starting from around August next year, but even then only getting back to something like 3% by early 2025. So, you know, it's not a, you know, in the absence of a major crisis or a major shock, it's not a return to, you know, those really low rates that we had before COVID, which I think is an important sort of framing for businesses and for everyone as we go sort of into the next little period. So then just to our economic forecasts. So as I said before, we have that sort of we have that slowdown in consumption continuing for some time, really into the middle of next year. And probably, I guess, aligns with that rate outlook where we have rates staying high for that period as well. And inflation staying high through this period as well, even though it is improving. So we have basically real consumption flat or even declining a little bit through the next year. And given the strength of population growth, what that implies is that per capita consumption is really going to continue declining quite substantially for some time. The good news there is that, you know, sort of from the second half of 2024, inflation should be quite a bit lower. There's potential that rates will start to ease at that time. And that's sort of where we do see sort of consumption starting to turn around, and that should then flow through to a bit more support for businesses. But there's sort of no doubt this would be a very subdued period for the economy. And then that flows through to sort of a wider GDP forecast. So we have growth running around 1% for this year and 1.5% for next year. So that's well below a trend rate of GDP growth, which is more like 2.5%. We have the unemployment rate starting to rise from that low level. So as the economy's slowing down, less sort of new jobs being created, and particularly given the strength of population growth at the moment, we need to create about 35,000 jobs a month just to keep the unemployment rate steady. So far, the economy's been doing that through this period of strength and resilience. We do think that's probably not sustainable for the longer term. So that should start to see the unemployment rate rise a little. And we do see it getting back to around 4.5% to 5% sort of by the end of next year. That's a reasonably rapid rise in the unemployment rate by historical standards, but it still only leaves unemployment around where it was before COVID. So it's sort of a long way from, you know, your GFC style or COVID style crisis levels of unemployment. And I think that's important framing. For wages, keeping an eye on the time, and I'll throw to Charles in a second for some questions. Wages we see sort of getting a bit stronger still to around 4%. So that's, you know, with that unemployment rate staying that low, that's, you know, still pressure on for businesses to compete for more for labour and pay more. But, you know, with that economy slowing, with unemployment particularly potentially ticking up, we don't see the wage growth, you know, sort of getting wildly out of control. And in some other countries, we've seen it go as high as 5-7% through this period. So we have it sort of staying around that 4% level, or even normalising a bit down from there over the coming year or two. And then for inflation, as I said, we do have that, you know, profile of inflation continuing to gradually improve. You know, Q3 potentially a bit of a re-acceleration, but the underlying trend should still be a slowing, and we have it getting back to the target bands of 2.5% to 3%, 2 to 3%, particularly to the top of that band, sort of in 2025. So that's broadly in line with the RBA's outlook as well. It's a really similar story around the world. So, you know, you can see across all the different countries, the major countries we look at, you have growth, you know, slower this year than last year and slower next year than this year. And that's, you know, the sort of unified theme around, you know, that higher rate scenario and slowing demand. The one outlier there is obviously China, but, you know, we have something like a 5% growth rate expected for them this year. That's partly that their 2023 is more like our 2022. It's that rebound from those lockdowns that they were experiencing last year. But even for China, a 5% growth rate is still fairly subdued or below where they were pre-COVID. And we know there's some challenges there in their property sector as well, which are an issue we can talk more about as well. Just lastly, the housing market. So the housing market is really caught in the middle of these different themes. So that rate impact has particularly impacted borrowing capacity. So this is sort of a back of the envelope look at how borrowing capacity has been impacted. And you can see that prices, which is the black line, have nowhere near adjusted as much as borrowing capacity has. What's happened there is that we've got these, supply challenges in the housing market, and also that really strong population growth. So those two trends running into each other. We saw for the second half of last year, the interest rate impact, the borrowing capacity impact sort of dominated and brought house prices down. Since then, it's been that supply and demand dynamic that's really been dominating in the housing sector, and that's seen prices basically recover their pandemic levels. So the black line here is that the overall house price for Australia, and you can see it's just about back to where it was in the peak before rates started to rise. So that's been a really rapid turnaround, and it has reflected that really strong population growth, I think, in particular, driving the housing market. Talk more about that if people are interested. The last couple of things I'll touch on, just I like to have a page on the risks. I call this all the reasons I might be wrong. So, we know financial sector issues can evolve, really and emerge really rapidly. We don't have, particular concerns at the moment, but we saw earlier this year that can happen. And that's something we have to be aware of. I said before about, how consumers respond to this period, how they adjust their savings rate, what decisions they're making around spending are, partly an unknown for us and a big factor. If households run down their savings much more than we're expecting, potentially demand stays stronger, potentially is less impact on consumption than we're expecting. But in that scenario, then maybe inflation is higher because businesses aren't slowing their pace of price increase as much, and then potentially rates have to go higher. So that's, there's flow-on impacts from those scenarios. Supply chains and geopolitical risks also ones we need to be alive to, particularly given events over the weekend. And then just the longer run. So, Australia's in the midst of, or the very beginning of a transition on climate change and energy that has, cost implications for businesses, but also potentially some opportunities. Aging population is another one where, even if we do go through this sort of slowing period and the labour market loosens a little bit, I think the reality is for the next, very long time, labour is going to be in high demand in Australia because we're going to have an older population, and it's going to be harder to find. We're going to have less, working age people per population. So that's a challenge that businesses are going to be grappling with, I think, for a long time. And lastly, then the productivity growth challenge that's been in the news a lot, but productivity has slowed down in the past decade relative to past periods, and particularly during this kind of COVID rebound, we've seen a big decline in productivity, though it's hard to measure productivity in real time. So that's a challenge for businesses and governments and everyone to be thinking about how we can get more productive and do more with less and continue to grow living standards. I'm going to wrap up there and throw it open to some questions if you have some, Charles. But yeah, happy to take questions.
Thank you, Brady. I think a really insightful overview on the state of the economy and what really resonated with me and for many of us. How we've worked in a non-inflation environment for a long time, a couple of decades in effect, and just highlighting those reasons why higher levels of inflation can impact on the various variables that impact on the financial system. So for me, that really came across in really strong layman's terms as to those important factors that we need to consider and what is influencing the economy. So thanks for that overview. What really, Brent?
Yeah, I'll a couple of questions. But
thank you.
Are there multiple economies sort of running in Australia at the moment? I mean, you see WA with a lot of growth, and also, having looked before, it looks like Victoria was, in a bit of trouble. WA was all blue sky. Are you seeing that? Is there multiple economies between the different states?
I mean, yeah, so we do look across different states, and you're absolutely right. Some of those commodity exposed economies have been been through a particular boom recently. WA chiefly through high commodity price period. Hasn't necessarily translated into a big commodities investment boom though. So mining investment hasn't necessarily taken off through the recent period. So sort of where we've seen that sort of two-speed economy open up before, particularly where investment was sort of responding to those high commodity prices, and we haven't seen that as much this time. And I think given the outlook for China, there's maybe not as much expectation that we're going to get that sort of sustained boom around commodities. So I think that sort of classic sort of 2010 style two-speed economy story is maybe
there's been an element of that definitely, but I don't, and it's flowed through to government, having revenue and things like that. But maybe it hasn't been kind of the key. I don't think it's the key driver. I do think there's sort of this more unified story around rates and inflation, which really have been sort of a global phenomenon, and then that makes them a national phenomenon that's been driving the impacts on consumers. There's probably some differences as well around those population dynamics. So we know Melbourne and Sydney particularly have been the beneficiaries or have attracted a lot of that sort of quick rebound that's happened in migration. So that's probably meant that Melbourne and Sydney sort of benefiting most from that around the skills influx that brings, but also potentially experiencing some of the more acute impacts in the housing market as a result of that as well. So you're absolutely right. There's different impacts going on across different places. I'd say too, from our survey, where business conditions have been a bit weaker, has particularly been SA and Tasmania in the last little while, but also small sample sizes for our survey there, and so we have to be a bit cautious being over interpreting those results. So, but, maybe that's there's definitely those differences going on. There's no doubt.
And what's happened over the weekend? Students going to impact maybe oil prices. Are you sort of looking at that now and extrapolating?
Yeah, it's something we're looking at. I'd be very cautious making any strong predictions about what the implications might be. The case last year where Russia invaded Ukraine, and we did have that massive kind of commodity price impact from that, particularly around oil and energy prices, but also around grains and food. I think there were some particular factors there around the role of both the Russian economy and the Ukraine economy in the world, and how they impact, as suppliers of those commodities across energy and food. And, don't know that those same implications apply to the Israel-Palestine or Hamas conflict. But, I think it's very hard to tell sort of what the implications could be. Conflict. We saw the Ukraine-Russia conflict sort of created a very significant global response, and actually a lot of the commodities impact came from the fact that there were restrictions put in place on commodities trade, and that then had implications for markets. So I'd be loath to kind of make any strong predictions about how other countries then respond to what's going on. So I think that's probably a critical part of the equation.
Brody, you highlighted the business squeeze and the impacts of wages and energy costs on business. With the actual impact of interest rate rises over the last couple of years, haven't had the same sort of impact in your assessment as the energy costs and wage costs
for businesses?
For businesses.
Yeah, it's something we don't look at in huge detail, I do have to say, but we do look at borrowing costs in our survey. They've clearly normalised, but businesses have also been in a strong cash position, so potentially there's been some changes in what businesses need borrowing. Borrowing, growth from businesses has been exponential, so very elevated through the recent period. So, and you guys might be a better place to comment on some of the credit risks there as well. But
the impact perhaps later on the retail household side on demand, that impacting on businesses. The businesses actually borrowing costs.
I think that's exactly right. So, the key thing we're watching is exactly how does that interest impact flow through to households' disposable income, and then what does that mean for their purchasing decisions? And that absolutely flows through there to businesses, exactly as I've said, around the impacts on the demand they're facing, and potentially the challenges they face around their margins or demand from consumers. So far, that's been holding up. As I talked about, population growth and other things have helped support that demand. But households are clearly cutting back, and we do expect that to sort of continue for the period ahead.
And as we move into this, I think that you're calling it stabilisation of inflation. I think we've set at a higher level inflation than we've seen in the past as a sort of base rate. And does that therefore impact on rates being at a higher base rate, what businesses have to deal with?
Yeah, it's a great question. I think the RBA would like the answer to be we're going back to 2.5%, and that's where expectations are anchored, and it's all clear. And inflation expectations do seem to have sort of stayed reasonably stable around that level through this period. I think the key thing to understand is inflation is still very high, even though it's coming down. So it's still running around 5%. it's going to keep improving fairly rapidly, partly because there's some base effects from last year. So inflation should get to sort of like 4 to 4.5% later this year or early next year. And then we have it getting to about 3 or a bit above 3 sort of towards the very end of next year, so end of 2024 or into 2025. I think then the question is, if we're at that sort of upper end of the inflation target band, so 3%, that's still quite different, I think, to where we were before COVID when we were at 2% or even, struggling to crack 2% inflation. So exactly as you say, that then has implications for the nominal interest rate. So, the RBA generally wants to think about sort of real interest rates over time or over the medium term. So, if the rate of inflation is higher, then the nominal rate that gets you the same real rate is higher as a mechanical result of that. So potentially that then does contribute to that, sort of expectation that we have that we'll be back at something like 3% for neutral. And, I think there were some dynamics in the last decade around aging and around productivity and around wealth inequality that, there's a whole world of academic research on that gets into sort of why rates were as low as they were and why inflation was as low as it was. There's an academic debate going on now as to sort of, are those factors going to reassert themselves in the next decade, or is the next decade going to look different? And, there's a few things like the climate transition and other things that potentially mean there's sort of high upward pressure on sort of neutral rates of interest going forward that potentially do mean we're sort of in a bit of a different world. So, but I would say that's the big question for us. Sort of our framing is something like a 3% cash rate is sort of our neutral rate going forward.
Conscious of the audience, are there any sort of questions of the audience?
Thank you. I was just wondering, what do global debt levels mean for inflation and taxation, in your opinion?
Yeah, it's a great question. So that's another factor that sort of flows into this story about where does the interest rate end up. So, countries are, debt levels are much higher, and there's an argument that pushes up the interest rate. And we've got also, sort of large amounts of quantitative easing that countries did, or central banks around the world did, including ours, during COVID, and that's now starting to unwind, or particularly over the next couple of years, starting to unwind. And so that sort of, adds extra sort of debt into the market that the market has to sort of find a way to find a price for. So that's definitely upward pressure on interest rates as well, exactly as you say.
Follow-up question on that, and it might be a tough one, but do you think it ever ends? Because I know that they just keep raising the debt ceiling. Surely there's going to be a come to Jesus moment where you have to actually pay the debt back.
Well, the economics literature would say, countries can sustain a nominal deficit, like, governments can sustain a deficit there so long as their economy is growing, right? So, what really matters for a country is their debt to GDP ratio. So, if your ability to service that debt as a country, if your total income is growing, and you're maintaining your ability to service that debt, then, potentially you can still run small deficits. What the US's position is, I think, will be different to that, where their, debt to GDP ratio is rising quite materially. I think, it's causing serious questions for them to stare down, as we're seeing with, sort of negotiations over debt ceilings and potential government shutdowns, which have been punted to November. So I spent a little bit of time in the US studying over there, and it's a pretty fractured system, and it's pretty hard even in Australia and systems that maybe work a bit better towards consensus to reach agreement on how to solve these big questions around how we sort of meet the needs of aging populations. The US, I think, has a more intractable or difficult political system to kind of work through those negotiations. So I don't have a forecast on where that's going to land, but the US has some offsetting benefits that mean that they can maybe raise a bit more debt than other countries. There's a very significant appetite for US treasuries as seen as a very secure form of debt. So that sort of helps offset in the other direction for them. But I do think, it can't go on forever, but how long can it go on for? Is it 1 year, 5 years, 100 years? We sort of don't know. It probably depends, again, on that bigger economic question of how they sustain their economy.
Excellent. Brody, thank you.
Brent.
If we can thank Brody for